I'd like to tell you a bit about the research that we conducted and was published very recently in the latest State of the Nation report of the Taub Center. Basically, these important issues that Claude raised about productivity gaps between Israel and the OECD countries and the widening of those gaps are a source of major concern in recent years for policymakers and economists in Israel. Just to recap what the problem is, well, as you can see, productivity gaps are high, and we're not seeing the conditional convergence that we would expect to see when a country like Israel starting below the OECD level. We see that the gaps are actually widening. So this is the problem, and Claude spoke about some of the possible reasons for that. He spoke about some of the industries, and we're going to try to focus the discussion. So let me start with the immediate suspects or the immediate questions that come to mind when you try to explain why there is such a gap and why the gap is widening. And one of the questions that many people ask is it because of the composition of industries in Israel? And what we were able to do, because we managed to construct a database that included multi-annual data for all of the economies, the industries in Israel and 12 OECD countries, which were quite representative, we were able to break it down to a decomposition proposed by Oaxaca back in 1973. It allows you to see what part of the productivity gap stems from composition differences, meaning had productivity level in each industry being exactly the same in Israel and the OECD, and the only difference would be the composition of industries, what would be the productivity gap then? And the answer is Israel would be actually better than the OECD in that kind of scenario. And that basically means is that the problem isn't with the composition, it's within the industries themselves. It means that in most industries, we are doing far worse than the OECD. This is also the reason for the widening of the gap, as you can see. So this is the first question that we try to answer. Another immediate question that people ask when speaking about issue of productivity and productivity gaps is, do Israelis work too much? And we know that this is the total gap. We know that average work hours in Israel per week is 37 hours compared to 33 hours in the OECD, but how is this affecting the productivity gap? So let's compare the productivity gap per hour to the productivity gap per worker and see how these differ. So like Claude showed, productivity gap per hour is about 40%. It's rising. You can see here the rise in the gap back in the recession in Israel between 2000 and 2003. Then we had very positive catch-up period of 5 years, followed by the subprime crisis in which the most OECD countries had it worse than Israel. And we also saw in recent years a reduction in the average number of work hours in Israel in a sharper manner than in the OECD. We still work more than in the OECD, but a bit less than we used to. So this narrowed the gap in productivity per hour. But as you can see, productivity per worker, the trend is now resuming to a rise in the gap. So again, the gap is widening. And as you can see, when we compare productivity per worker to productivity per hour, we can see that differences in work hours can explain up to, at most, 50% of the productivity gap. That is in an extreme scenario in which all the excess hours do not produce any extra output. And basically, Israeli workers could have produced exactly the same had they worked the same hours as the OECD. I'm not saying that's the case, but that's the upper bound of how much the excess hours are hindering labor productivity in Israel. To the more interesting questions that Claude mentioned, which are the industries that are responsible for the bulk of the productivity gap? And Claude mentioned retail, trade, and the food industries and banking. Let me show you 7 top industries that account for 75% of the productivity gap between Israel and the OECD. And these are the industries, but what are the percentages? And the gap today is about $12 per hour. And this is what each of these industries account for. And you can see the major industries that contribute the most to the productivity gap are trade and services industries that are mostly oriented in the local market. We have retail trade, like Claude said. We also have the food industry, but also hotels and restaurants, wholesale trade, which is a big deal, much bigger than we thought. And we had other business services, which is a very big industry. And what is exactly other business services? Well, it's security guards, which Israel has a lot more compared to the OECD. It's also cleaners and kitchen workers, but it's also accountants, lawyers, economists, psychologists, and these actually account for the bulk of this industry. And we found that this industry in Israel accounts for 22% of the entire business sector work hours, compared to only 13% in the OECD. Now, because this is mainly high productivity, an industry which is characterized by high skill level workers, mostly accountants, lawyers in most countries except Israel, it's supposed to be boosting productivity in Israel if this industry is so much larger compared to the OECD. Problem is wages for those workers, economists, accountants, psychologists, has stagnated between 1995 to 2008. In fact, it's declined slightly. And this is telling to us that maybe there's a surplus of workers in that industry, especially given the fact that it's much, much smaller in the OECD. So this is part of the story. But another more interesting question is not only why are the gaps so big, but why they are widening, Claude. And who are the industries that account for the widening of the gap between 1995 to 2009? And here, 7 industries account for 96% of the widening of the gap. And those industries are publishing and printing, fabricated metal products, food and beverages, retail trade, post and telecommunications, other business services, and wholesale trade. And these are the percentages of contribution. And as you can see, wholesale trade is a big problem, accounting for 30% of the widening of the gap between 1995 and 2008. And to understand how problematic each of these industries are, we need to see what the relative share in work hours is. So you can see that wholesale trade, for example, accounts for 30% of the widening of the gap, despite the fact it only accounts for 8.6% of business sector work hours. So it's very problematic. It's 3.5 times more problematic than its relative share in work hours. Same goes for post and telecommunications, even though since then there's been a reform. Food and beverages, another very problematic sector, and fabricated metal products, and publishing and printing. As I said, other business sectors account for a big part of the productivity gap and for the widening of the gap, but it is proportional to its size, and the same goes for retail trade. So these are the main problems. Now, there's been in the audience a question about what's more important, exports or imports. So let me try to answer that question. So there's been, like Claude showed, a graph by the Bank of Israel showing the high correlation between share of exports to being able to be at the OECD productivity level. When we broke it down to more industries, we saw that this correlation only exists in the manufacturing industries, but there it's a very high correlation, about 0.69. But this does not constitute causality. This is only at one time period, and really it could be that these industries are exporting because they're productive, not the other way around. So to answer this question, we need to have a time series, which we did. And when you look at the time series, you actually see that imports are the main driver of catching up. So these, again, are the manufacturing industries. And as you can see, industries in red are low-tech, yellow are medium-tech, light green are medium-high tech, and dark green are high-tech. And the industries in which there's a low exposure to imports, then you see that there's no catching up of the gaps. The red line here is when Israel productivity is growing the same pace as the OECD pace. These are industries that are now growing at a faster pace. Productivity is growing at a faster pace than the OECD. I'm not saying that their productivity level is higher, but they are catching up. So these industries are catching up, and these are falling behind. And look at food and beverages. This is a big story. There's something very unusual here. I'm almost done, Leo. I have 1 minute, and that's okay. As you can see, more high-tech industries tend to be more open to imports in general, but compared to the low-tech industries, but we have the exceptions of the leather, textiles, clothing, and wood, which were open to imports, and look at the difference it made. Of course, they had to become more efficient. Some of them shrunk to survive, and we had some factories closing, but the ones that did survive became more efficient. So this answers the story. One last reference to something that Claude shows. It showed that trade and services have diverged from manufacturing, while growth in manufacturing or productivity in manufacturing has grown. It stagnated in trade and services. But this wasn't always this way, and this is, again, to convince you about the importance of imports. So before we opened the Israeli market to imports back in the early 90s, we had the same pace of growth. And here's the second part, which Claude has already shown, the divergence after the opening of the Israeli market to imports. You see manufacturing productivity is booming, and it's stagnating in trade and services. And as you've understood from my part of the presentation, we have a big problem in trade and services and in the locally oriented industries. One such example is the food industry. And I'd like to hand it in to Gilad to speak a little bit about that, because it's really an unusual story that he's going to be telling about that industry.
Okay, so I would like to talk about the cost of living and later on the food. So as we mentioned earlier, the price level of private consumption in Israel is relatively high when we take into account that wages in Israel are relatively low. And what we see in this chart is a simple comparison of the price levels across OECD countries, and when we take into account the income levels in each country. As we can see, there is a high correlation between these two variables. No surprise, richer countries are more expensive. And if we add a regression line, we can see that Israel diverges upwards from the line, which is an indication that Israel is higher than prices in Israel are higher than expected, given per capita GDP. Now, if we conduct this comparison each year separately, and we check Israel's diversion from the regression line, we find that the excess price level, the deviation from the regression estimate, fluctuates around a long-term average. This is not surprising and not unique to Israel. As expected from basic macroeconomic theory, the relative price level between developed countries tends to fluctuate around the long-term average, phenomenon which is known as the law of one price in its weak form. Interestingly, if we rank OECD countries by the relatively long-term average, we find that Israel is ranked relatively high. In fact, Israel is ranked the highest among OECD countries, lower only than Japan. And this result is robust and consistent also in examining shorter or longer time periods. So that's our result examining the aggregate price level. But the aggregate price level is comprised of different consumption categories. And what I'd like to discuss in the remainder of my presentation are food prices in Israel. So the food industry in Israel went through some interesting changes in the past 10 years. What we see here is the return on capital, the profit margin in manufacturing industries, and separately for the food industry. While the average profit margin in manufacturing industry has been relatively stable over the years, the profit margin more than tripled in the food industry. And this happened relatively in a short time period, starting from around 2005, 2006. Now, what caused this outstanding increase in profit margins? A possible explanation would be that the food industry became more efficient, and that is possible. But I doubt that to be the main reason for the rise in profits. And that is because when we look at the change in price level, we find that food prices increased dramatically, starting from around 2005, 2006. About the same time, profit margins increased. What we see here is the different consumer price index categories since the year 2000. And we could observe that the food prices increased faster than the general CPI index and faster than most other categories in the index. Well, maybe we're missing something. Perhaps this is due to a world increase in commodity prices. Let's examine that. This is the Israeli food price index divided by the food price index in the US, G7, and the OECD average with 1999 as the baseline. As you can see, food prices in Israel have increased also compared to other developed countries, starting from the same time period, around 2005, 2006. And we find this result also when we compare prices in absolute levels and, of course, various food products. We used to be cheaper. We used to be cheaper in most food categories back in 2005. But by 2011, Israel had become more expensive. So why did food get more expensive at the same time that profit margins in the food industry had gone up? The best explanation I could think of is a decline in local competition. But what is enabling this increase in profits? If food prices are higher in Israel than overseas, and assuming that markets are open to foreign imports, one could expect prices in Israel to equalize over time to the global price level. But unfortunately, in Israel, there is no free trade policy when it comes to food products. And what we will see here is the percentage of imported goods as a share of expenditure in various categories. Since the major trade liberalization reform in the early 1990s, the share of imports has increased in a wide range of commodities. Yet there is one commodity that the share of imports has not increased and will remain relatively low. This commodity is food products. This sector has remained protected from foreign competitive imports, a policy that enables a significant price gap between Israel and other OECD countries. So I have one more slide, but Eitan, why don't you present this one?
So Gilad showed us how closed the food market is, the food industry is in Israel, and the question is it really that we can't import foods? What's stopping us from importing more food? Now, Claude, you mentioned some of the regulations and the barriers, but I want to show you something really interesting and just raise a question to why that is, and maybe we can have a later discussion about that with the panelists. So basically, when we look at the food categories in Israel, we can divide it into two groups. You have the big industries, big categories, in which there's almost no imports. But there's also another group of the smaller categories, like fish, processed vegetables, in which you have much more imports. So why is it that you cannot import where you have the big industries, but when it's the smaller industries, it's all of a sudden so easy to import? Why can you import fish, but you cannot import meat, for example? So is it a story of protecting the local industries? Is it a story of kosherness? Is it a story of regulation? Or is it simply a story of bigger groups having stronger lobbies? And I leave that question with you.